This is the Daily Market Comment for Monday, January 10th by Mario Satikiriakos. I'm Christina Marujos and thank you for joining us at XM.com. The U.S. jobs market is approaching full employment conditions with impressive speed. Even though non-farm payrolls fell short of expectations in December, with the economy adding 199,000 jobs, the rest of the report was very encouraging. The unemployment rate fell to a new post-pandemic low of 3.9%, and most importantly, wage growth was far stronger than expected, adding credence to the narrative that companies are starting to compete for scarce workers. All this paints a rosy picture for the labor market. Markets reacted by betting the Fed will be forced to expedite its normalization plans to prevent strong wage growth from feeding inflation. The implied rate probability for a rate increase in March now stands at almost 90%. In total, markets are now pricing in 3 Fed rate hikes for this year and equal chances for a fourth one. When rate traders bet on faster Fed rate increases, that typically benefits the dollar as yield differentials widen to its advantage. However, that's not how it played out on Friday. While U.S. yields did spike higher, the reserve currency didn't follow the playbook and instead lost ground. One explanation for this dichotomy is that short-term European yields also jumped. Inflation in the euro area hit a new record of 5% in December, fueling bets that the European Central Bank will also get the interest rate ball rolling soon. Money markets have pulled forward the first minor ECB rate increase to October of this year. Admittedly, this speculation seems excessive. Hence, relative monetary policy still argues for a lower euro-dollar, as there is scope for markets to fully price a fourth Fed rate hike this year, whereas the ECB is extremely unlikely to pull the rate trigger in October. Stock markets have been under pressure since the year began. Most of the damage has been concentrated in the tech sector that's the most sensitive to higher yields, hence why the Nasdaq lost another 1% on Friday to close the week 5.5% lower. Valuation has been judge and executioner in equity markets lately. The spike in yields has seen the outrageous multiples of many companies compressed to reflect reality, with the riskiest names suffering the most as investors prioritize steady profits over future promises. Whether investors continue to position for a world of higher rates could depend on this week's events, particularly on the latest U.S. inflation report on Wednesday and the testimonies by Chairman Powell before Congress. This was the Daily Market Comment here at XM.com. Have a great week.